All right, let's get started with the first conversation today. We're talking about retirement. Now, it's something that a lot of people work towards for several years, and then when you finally reach that point, or you reach close to that point, there's this mammoth task in front of you. How do you manage all of the payments? How do you move or transition from a monthly income to a portfolio that you have to manage that has to eke out what you need for the rest of your life? Well, we're talking about the several things that you need to bear in mind, the pointers that might help you along that transition that you have to make. My guest today is Arvind Rao, who is a chartered accountant, a certified financial planner, and the founder of Arvind Rao and Associates. Thank you so much, Arvind, for joining me. And I'm sure that over the course of your career, you've interacted with a lot of people who are making that transition and helped them out. So my first question to you is this, and we'll break this up into parts. What are the first few things that an individual should do if they have just retired or if they are in the run-up to retirement?
Thank you, Alex. And this is a very important aspect. And my first suggestion here for people, and I say this because I often find people don't do this, which is that when you are about to retire or you have just retired, people should take some time and clear their minds, one. Number two, it is important that they set the different buckets for retirement, meaning what are the various activities or what are the various purposes for which they require money during their retirement, and give it a monetary target there, one. And believe me that this may take a lot of time as well as multiple iterations on their end, because typically when you see a lot of money that has already hit your account or is going to hit your account, you will want to do many things, but depending upon how much that money is and what you require for a longer time zone of around 20 to 25 years, it may be difficult to do all of it. More importantly, one final point here I would add is that it's very important that people apply a reality check to whatever they are thinking of, because many a times people tend to use thumb rules or upwardly increasing an estimate for their monthly needs, trying to match up with a perceived lifestyle or something, which sometimes leads to absurd expectations from a retired person. So taking a reality check in the end is very important.
Okay. So those are the things. Okay, so you said take a little time, and I don't think that that's going to be a very difficult proposition for people who are just about retiring. So that's a positive, and it's a positive note to start on. But talking about those large amounts that will likely hit an individual's account, right? If you're talking about the likes of gratuity or a provident fund amount or a national pension scheme, this is going to be a large amount of money sitting in your account. How do you manage that?
Alex, one thing that I've seen practically that happens, and I in a way think it is for the good of the retired person. Like when you say, when imagine a day when the person retires, all this money doesn't hit the person's account immediately. So what happens is things like the final salary, leave encashment, all this comes immediately. Some things like gratuity takes a little longer. It may take maybe 15 days to a month. And the PF or the Provident Fund takes anywhere close to 2 months for the money to reach the person's account. So all these money, when they hit, definitely at the end of 2 or 2.5 months, somebody has a large sum in their account. And I go back to my answer to the first question, that it's here that those buckets or those targets that one has laid down for what they wish to do in their retired life is what will determine how to use or utilize this lump sum money that is available in the account. Because it's a very well-known fact, but let me break it again for our viewers here, that today there is no investment instrument that gives tax-free income. which means in retirement, whatever or wherever you park the money, there is going to be a certain tax that is attached to it, and which becomes all the more important to be taken care of during retirement, because one does not want to be paying a lot of taxes on the reduced income that they may be earning. So how much of the lump sum to be deployed in various instruments like FDs or government schemes all depends upon how do you categorize when and where you require this money for.
And that's completely fair, and that is a very individual thing, right, Arvind? Because one would say that they have short-term requirements where they need to buy certain things, or they have long-term travel goals that they want to do, that they've spent their entire lives working towards. So what you're saying is list out the goals that you have, and those goals will obviously change once you hit retirement. I take that point. I want to talk specifically about NPS, because here, to a certain extent, that tax issue that you were talking about actually comes into play to a certain extent. The NPS gives you the option of pushing forward the taking of the money. So you can actually leave it lying in the NPS for longer. You can choose to take a part payment, and you can choose to take a larger part payment. Several options available. How do you decide which you should take?
Again, an interesting question here, Alex. So NPS has definitely moved a long way from when it got started to today, where it has started allowing a lump sum to be withdrawn at the point of retirement. So my two aspects here that one has to keep in mind. One is not many people who would be retiring in the, let's say, this year or in the coming 2 years would happen to have a large amount in NPS, predominantly because NPS has started catching attention due to the tax benefit that it has started getting in the last 3 to 4 years, predominantly. So all those people who are retiring now will not be seeing a very large amount in the NPS, which in turn can be utilized to give some meaningful income during retirement. So for these people, it makes sense to delay the or defer the withdrawal to a maximum point where they can, and at that point take up the lump sum that is tax free and move the rest into the annuity. For others who are much younger and are probably looking to retire after 10 or 12 years, I think for them, if they have managed to accumulate a substantial amount, one has to take a call how much would the annuity actually pay them, and whether it how well it fits into their monthly budget. If there is a strong need for a recurring income, then more of NPS should be monetized to take annuities, or else the lump sum option works better for them.
Understood. And there's a possibility, Arvind, that the NPS rules could change in the interim between now and those 12 years passing. But let's talk a little bit more about what you mentioned just before this, which is the tax aspect, and you have to bear in mind the tax aspect you said. Let's talk a little bit more about that. How does one manage those taxes? Assume that you've gone past the stage of identifying what buckets to put what in. How do you manage that large amount of money? Because in all probability, this is more money than you have handled throughout your life.
Correct. Alex, I'm very glad you are asking this question at this point here, because typically I see people shunning away from certain fixed income or debt products, these retired people, because somewhere at the back of the mind, they keep thinking that 30% is my tax rate. So whatever fixed returns I'm getting here is actually going to be minus 30%. But believe me, when we have tried to put figures on paper, 30%, it depending upon whether a retired person is actually eligible for some pension or not, it's not always necessary that they're going to pay a 30% tax on fixed income instruments. So we need to understand that for a retired person, they may want to take a lot of risk and deploy in risky instruments, but the ground reality is that they should not be taking. And the moment you talk of less risk, it is fixed income instruments that will find its place there. So one should actually prepare a tax forecast of their incomes, which takes into account the different heads in which the incomes come, calculate what is the tax on it, see if they are not yet crossing the 10% or the 20% bracket. To that extent, they can keep filling it with the fixed income space. And based on that, they can then look at more in investments which probably defer payment of tax to a later date, or where taxes are paid by way of capital gains on redemption. But this, and I say this is important because this solves a lot of problems. I mean, when we have shown people that, why are you running away from something like a bank fixed deposit or a company fixed deposit? Because your average rate of tax is like 10 or 12%. So even if you happen to get a 7% interest, you're only paying a 12% tax on that. That really relieves them of that pressure, because then they're like, okay, then I really don't want to look at equities or some other segment.
That's a very fair point, and I think to a certain extent they're also used to paying that much tax towards the latter part of their career, which is why they have this sort of mindset, I would think. But having said that, yes, Arvind, I've often heard that people want to take it easy in terms of not taking too much risk. Would you say that you need to take a certain amount of risk because now you have your life expectancies that are going up significantly? You would also want your corpus to grow, and therefore you should ideally have some exposure to equity.
Absolutely. Exposure to equity is definitely required, because there will be buckets in one's wish list which will be like, I want to leave more wealth to my to my children, one, or where there are certain milestones or buckets which require larger amount of money after 10 years, 12 years. These buckets definitely warrant exposure to risky assets, which will include equities or equity mutual funds for that matter. So it's not that a retired person should not invest here, but while I say this, my earnest advice to viewers is that before taking a call on what has to happen 10 or 12 years later, they need to be sure that whatever is the money or income requirement in the next 3 to 5 years, those are first taken care of. And then you look at equity or like risky assets.
Understood. Coming to the last couple of questions, through a person's work life, there are a few, I say thumb rules here, but in the case of a contingency fund, normally you say, 6 months if both people in a family are earning. If there's one, then you generally have more months worth of your expenses that are covered in terms of your contingency. But when you're retired, what is the ideal amount of contingency that one should keep?
Well, the contingency here in terms of the months of expenses may not differ a lot, because most people, if they're still using credit cards, so one always can, at the back of their mind, keep a thing that there is some revolving credit that they can use in case of such extreme emergency. But otherwise, a 6-month expense buffer to be kept as emergency fund is good. Alex, one more thing I'd like to point out here is having a separate fund for medical emergencies. Because not all retired people are lucky, I should say, where they still have employer-provided medical cover beyond retirement. And definitely there are Mediclaim policies available, but as age advances, these policies have various exclusions or they have limits. So along with the normal contingency fund, a medical contingency fund becomes very important to be maintained.
That answers the last question that I would have asked you very neatly. I think we've covered most of the bases, Arvind, and I'm sure if our viewers have any questions for us, they'll write to us and I will get you back on the show to get those answers to them. But it's been an absolute pleasure speaking with you. Thank you so much for taking the time.
Thank you for having me here, Alex.